one. Hey, Larry, thanks for jumping in.
Sure. Good to be here.
I tell you what, this is the first time I've done this to have someone in the studio, so you're the maiden voyage on this.
Glad to help.
Yeah. So we were just talking about long-term care, and I've been in the long-term care business for 13 years. How long have you been in the business for long-term care?
Since 1990.
1990.
I've witnessed the carnage, and we're rising from the ashes.
Yeah, so you've seen a lot happen, and you've been with several insurance companies, and you've seen a lot. And so I think that your experience is very helpful for where we are today, and that is there's a lot of unreal clarity. The people have a lot of assumptions going on right now. Listen, in my office here, I've got posted over there rate increases from different carriers. Clients are going through that. And so there's a lot of misconceptions about what's going on, but at the same time, we can't avoid what the custodial care crisis is in the country. So it's helpful to have that experience. And I always tell people, learn the truth. There's a lot of people that are not learning the truth. They're running with assumptions in retirement. And so I think it's important to have truth, and your experience is very valuable. With that, let's get into the first question here. What have you seen over the past 30 years? That is, how can you summarize what's been going on the last 30 years in the long-term care marketplace?
Sure. It's interesting. When I got into the business in 1990, Amex Life, which now today's Genworth, the industry was already 14 years old, 14, 15 years old. But the amount of claims experience was just beginning to come in. And as time went on, we also had, we called it the senior market. It was a huge market, very different market, obviously, than today. Average issue age was 70 years old. Underwriting was a lot easier then. Products were, in many cases, more generous in terms of what they paid for. So then you had the added complexity of distribution, which really was a tail wagging the dog saying to the carriers, if you want us to sell you, give us certain features. So as you march forward from 1990, what I witnessed was the industry growing rapidly. And by the time we hit about 2000, 2004, we were $1 billion industry and about 180 carriers. But the problem is, we didn't have any real experience up until that point. You start seeing carriers beginning to see the claims experience come in and their problems. And I think the bellwether event for me that kind of wraps up the first half of the industry was a Society of Actuaries conference. Exciting bunch of people. You wouldn't want to be, it was in Las Vegas, so I got to believe the casino managers were a little nervous knowing there were 700 actuaries floating around the table. But anyway, it was announced at that meeting that based on ample experience now, we missed the mark in several real important areas. Lapse rates, the amount of liability you expect to see on the books at the end of the life. You ever see lapse rates projections at the old days of 10, 12%, when the reality is all that liability stays on the books.
Wow.
You have that problem. The other problem was morbidity. They really didn't understand, because they didn't have experience, what the long tail on cognitive impairment would be. So you had a lot of products out there with lifetime benefits that were underpriced. And then the other area that was interesting, they got it wrong on pricing inflation, 5% compound. So
yeah, because we were going to enter an era of low interest rates for some time, many years to go.
Yeah, it was about 20 years we were in that state.
Yeah,
so you had the perfect storm forming here. And it was shortly after that meeting, we started getting into 2006, 2010, when we start seeing the experience catch up. We see carriers now doing enforced rate increases, and we see carriers pulling out of the market. Big players, Prudential and Hancock, who I was with, they exited the market, all because the profitability in that business, coupled with enormous claims costs, it was a recipe for disaster, if you want to use that term. So it was at that point where we start seeing carriers waking up, underwriting differently. Those who are committed to staying in the market, also tightening up products in terms of what they're going to pay for, and then pricing going up. So everything started based on that learning curve early on. Carriers were starting to respond to that. The problem is, the market back then was predominantly traditional, non-guaranteed long-term care products. Nothing wrong with them. And at that time, maybe two players in the hybrid world. You saw One America Golden Rule, and then, of course, Lincoln.
Yeah.
And so now, proceed to where we are today, the traditional long-term care market got a serious black eye. A lot of rate increase activity, products getting increasingly more expensive.
And you would say what year, we're talking from maybe the 2015, 2018 and up to now, or what are we talking about?
I'd back up a little bit, probably 2012, 2013, we're starting to see the reaction to all that rate instability. And the desire for guarantees.
Yes.
And the ability to recapture what you paid back in the form of a death benefit. So we start seeing more players entering the market. You start seeing One America getting very active in the market.
Yeah.
And then now you have Nationwide and a number of other big carriers.
Because they're coming in with a different chassis too, right?
Yes.
It's a different chassis than historically 30 years ago, 40 years ago.
Correct. Yeah. You used to see just plain Jane life insurance, but now it's all UL.
Yep.
But now we've reached that point from about that date to the 2015 or so, where we're seeing this switch in terms of product dominance.
Interesting.
And if you look at the market today, there's only 3 traditional carriers really to speak of.
Yep.
And there's 8 or 10 big carriers playing in the asset-based world, as they like to call it. So where does that leave things? Is there a hope for tradition?
Right. And I want to be clear with the audience too, Larry, about traditional.
Sure.
Because people have a misconception. So traditional means that it's what we call a health-based asset, or a health-based foundation, which means it's like a health insurance product where you pay a premium, which like your car insurance, like your home insurance, and home insurance is probably the best. And that is, if you walk away from your home insurance, there's no value in your home insurance. If you decide to cancel it or move out, there's no value. But at the same time, you're paying a few dollars a year and you're insuring your house of $500,000 or $1 million or whatever that number is. There's an insurance for the house. Same thing applies with this health-based insurance, which you're speaking about, called traditional.
Yeah.
Asset-based is something to say that along the way, there will be an asset sitting there.
Yeah.
Somehow, some way, there is an asset in the person's portfolio of their assets.
Yeah.
And there's long-term care of things that are sitting in there. So I just want to be clear about traditional means that health-based along the way.
Yeah, it's interesting you bring it up because you're right. There's also an interesting twist with this health-based concept that it acts like a disability product at the time of claim. And I talked to a lot of people, especially in the business environment. How do you make long-term care make sense to somebody who's younger, who perceives that this risk is 30 years away, 40 years away? But I could get hurt along the way. So when you look at how the triggering mechanisms work, it's either a physical disability or a cognitive loss. Doesn't matter how it happened, doesn't matter what happened, as long as you meet that trigger. So where we are now, we've gone through this great learning curve. The traditional carriers, I think, are in much better footing now because they've integrated next to 0% lapse rates, appropriate interest rate assumptions. We pretty much have a handle on how morbidity works in general. So products generation-wise from 2015 on up are really solid. You hear about rate increases still happening, but that's on the old legacy business, right? If you look at the investment advisory, financial advisory community, they just think traditional product it's something you don't even want to touch. It's toxic.
Right.
And that's not really a fair assumption anymore. I see where that fear came from, but to the point where you're going to literally negate that product from your suite of strategies to manage long-term care costs in the future would be really short-sighted, because at the end of the day, like you pointed out, you still have significantly more leverage for the premium than you can create with the asset-based product. The asset-based product and the traditional type products are out to solve different fears and different desires, which I think we'll get into a little later. So wrap up the whole industry thing. We've just gone through a huge learning curve, and those who remain in the business, I think, are going to be in for the long term, because we pretty much can't get much more conservative in our assumptions and assuming that no risk falls off the books sometimes.
You know a lot, because the long-term care industry in 2025 knows a whole lot more than it did 15 years ago.
A whole lot more.
Yeah. And the premise of this, Larry, is I operate the channel Talking Turning 65. My main goal is to share with people the truth. Okay. And what we don't know is what is going on in society when it comes to custodial care. And we know a whole lot more now than we did 15, 20 years ago.
Yep.
And I want to just let people know it could be the Alzheimer's website, alz.org. Take a look at that. See if that doesn't, we all know people that are having more and more dementia at younger and younger ages, and that is all custodial care expenses.
Yep. And I think it's important that when people think of custodial care, they really don't know what it is. Of course, Medicare doesn't pay for it. You're on your own.
Yes.
When it comes to that. And that's what people lose sight of.
Yes.
They don't think, in fact, they think of a nursing home when they think of long-term care. To your point, it's a real misunderstood idea.
Let's turn the page and let's talk about COVID for a moment.
Sure.
Let's talk about COVID. We're 4 or 5 years removed from COVID or more, or of course there's variants out there. And anybody that knows my story knows that I too went through COVID, and I fought it for 3 or 4 weeks in the home. And then I came out, and then 8 weeks later, I ended up in the hospital, not because COVID had caused a lot of other problems with me. Okay. So I got to ask the question, what does that look like for underwriting purposes now, or what are we seeing with claims? Is there any indication this early, 3, 4, 5 years after that is in the long-term care space, in the custodial space? Is there something that says this is what COVID has caused in the industry, in the long-term care industry?
COVID's changed everything.
Okay.
I'll tell you. So in general, we have a less healthy populace.
Okay.
Right? And we see that in underwriting. We see people with more chronic conditions, chronic diseases, obesity, depression. During the part of the impact of COVID, it wasn't just COVID, it was linked to the shutdown. And what we see are increased levels of alcohol consumption. When you go to a bar and they give you a shot of something, it's a legitimate shot. But when I'll make my own shot at home, it might be a lot bigger. Interestingly enough, when we look at the 5 reasons we're declining cases, alcohol consumption, excessive alcohol consumption is in the top 5.
Really?
Yeah.
Wow.
Yeah. So when we think about the impact of COVID, at first when it happened, nobody knew what to do with it.
Yeah.
And in fact, My company said, listen, you cannot even apply until you're free from COVID for 6 months. After a couple of months into it, they realized, okay, people are recovering, so we removed that draconian measure. But yeah, bottom line, there's a less healthy populace out there, and we see much higher incidences of depression, major depressive disorder, due to the shutdown, and then just overall health. A lot of people were impacted by the vaccines, positive, negative, that impacted some chronic issues. Yeah, and we're still seeing it. We're still seeing the tail on that.
Yeah, and we probably will for years to come. There probably is going to be lingering issues, whatever those may be, from that COVID thing.
Yeah.
So interesting. And also I want to add one other thing too, Larry, that the COVID has done. It has forced us more into, I'll give you an example. When we go shopping, we actually buy our groceries online. We still drive to the curb and have them loaded in our drive. There's a change that COVID brought around, right? And in the insurance industry, a change has happened where like over in the Medicare market, everything is being driven to paperless. Okay. And what's interesting about this, Larry, is that there's a lot of people that are not paperless in nature.
Yep.
All right. And so that means it's a remote sale. It means that, you know what, you may not have physical paper on your hand, and maybe coming over your smartphone or whatever.
Yep.
And I can tell you, as an agent servicing my clients and helping people along the way, what I have done is I've employed tools and technology that makes it really, really easy. Even if you don't have Zoom, I can still share with you ways that you can see my screen. And so I'm trying to reach out. Everybody's got a smartphone. So with that, I can work with that. And it's very important. But the message is, after COVID, is we are remote and we're requiring paperless.
Yep. Yeah, paperless is an interesting topic with our company. We've actually gone a long way towards electronic policy delivery and things like that. Part of our challenge, distribution. The average age of an agent's like 75 these days. And when we try to do these really cool cutting edge things, it annoys them. They say, I want paper.
Yeah.
And that's why we still, if it's desired at the time of policy delivery, you want a bound paper copy, we'll get it to you. So we haven't totally gone away, but you're right though. It's a big deal. And I think distribution is the most challenged aspect of it.
So there's two aspects I want to clarify on that and go back and clarify. There's the application process, which is paperless.
Yep.
But then there's the delivery process of, to your point, is if this policy, Larry, that you've sold me is going to be worth $200,000 and growing.
Yeah.
All right. For instance, I just sat and viewed a client of mine that he's had the policy. It's $1 million policy now. And he's paying $5,000 a year as a business owner.
Yeah.
62, 60, 61, 62 years old. As a business owner, he's writing off that $5,000. And this thing is worth now almost $20,000 of monthly benefit.
Wow.
Okay.
Yeah.
And I just met with him a couple of days ago. The point of it is, and the cumulative for himself and his wife is well over $1 million now. But what I'm getting to is that should be bound. I'm just saying, I want to hand somebody a bound policy that says this policy is worth $200,000, $500,000 and growing. Yeah. Anyway, there's my little.
You're memorializing a major transaction.
Exactly.
It's not. So I won't mention the carrier, but I had an agent called who was very annoyed. It was an asset-based carrier.
Yeah.
And they wanted a paper copy of their policy, and what they got was a stapled document.
Yeah.
Unbound. And I'll just say the client was not impressed.
Yeah. Yeah. So anyway, I hope that people are able to get that. Let's move on here so let's talk about women in long-term care. All right. And there's really two aspects for women in long-term care. The first topic is on my heart, and that is women are unpaid caregivers. And in other sessions, why people can take up, I'll bring research to the table as to what we're seeing. And you and I, Larry, have been in the business long enough that we know we've seen numbers of 70%, maybe 80% of unpaid caregivers are female. It's the mother, it's the sister, it's the daughter. And in fact, I actually have on the shelf here Harley Gordon's book. Called The Conversation. And so for those that haven't seen that book, get a hold of that book called The Conversation. And he has statements in there that basically say things like, not only does the health of the one that's getting care go down, but the health of the caretaker is driving down as well.
Yes. It's a real challenge. When we think about traditional society, it tends to fall in the woman's lap.
Yes.
If it were the reverse, how effective would the husband be, or you wonder.
Yeah.
But it's recognized just in our own underwriting and claims that the sad reality, if you have a normal dispersion in age between older male, younger female, the impact that the male has financially on the family and physically on the family impacts the caregiver immediately. He passes away. She's a lot poorer than she was in the beginning. And her health's been impacted. And that's when the kids have to start engaging. So I think the whole idea of custodial care, there seems to be a reluctance or either a misunderstanding to how long a caregiver would have to take care of somebody. And they just assume, I'll take care of him. He'll get better soon. And we know that doesn't happen. So that's where long-term care planning has to reach a point where you need to communicate the reality to people that, listen, at the end of the day, this event could go on for years.
Yes.
And here's the problem. There are no statistics on you as an individual.
That's right.
Could be weeks, could be days, could be decades. You never know. It's an area that has to be addressed from an educational standpoint more aggressively, because caretakers need to understand that if they could be on the hook for a long time, can they sustain it?
That's right. That's right. That's good. So let's move on to women receiving care. All right. Now, before we get there, obviously, we saw a move in the marketplace. What was it, 10 years ago? We went to gender-based pricing. All right. And up until that point, males and females were priced the same. But if that was at time 10 years ago or whatever, or maybe more, 12 years ago, gender-based pricing means that females are rated higher out of the gate. All right. And there's a reason for the insurance companies found that out. And so if the insurance companies know about this, you should too. That's the essence. If the insurance companies are based on math and science, right? Numbers are everything. And so if they're rating the females higher out of the gate, that means that people that have been saving for retirement, they want to have that golden retirement, they have got to know that the females are going to potentially drain more of the retirement savings.
Oh, yeah. And we look at the claim side of our business, for instance, and what we see is the assumption that the wife or the spouse is the caregiver, assuming that role, which delays a male from going on claim. And by the time it gets so bad, meaning maybe she's breaking down. That claim's comparatively short. And then by the time the female goes on claim, okay, that's right. First of all, we see more than half our claims are females.
Okay.
So that's important to think about. And those are the claims that are going longer. Because there typically isn't anybody left to take care of that person, or the kids are tag teaming, trying to make it happen.
Got it.
But yeah, if you think about it, it's more of a theory, but it makes sense where the female caregiver will delay the claim on the male. In many cases. And then by the time that guy goes on claim, there may not be much time left. So then she's left holding the bag in a compromised financial position now.
So let's stop a word for the emotional side of the business, or emotional side of the claims process. And I remember sitting with some friends of mine that were wealthy, and they had no long-term care coverage. And yet I was telling her, she's just a little bitty thing. And he's a big man with Parkinson's. And I told them on their couch, I remember sitting on their couch, I said, open up the wallet and strike checks and start paying for care services in this nice home. Wouldn't do it. And it wasn't until later, and he was demanding. He didn't want anybody else but little old wifey, she's well under 100 pounds. She's still living today, and she is struck with a major amount of dementia going on for a long time, now stressing out her daughter. Okay. The point of it is, either you're going to pay out of your checkbook for this care, and if you've built up yourself $500,000 or $1.5 million, $2 million, or whatever that number is, know the fact that you're going to be paying out of your checkbook. And I want to stop for a moment, and I want to address something I think is very important. People, Larry, I believe, think that they're going to pull from their 401k and their IRA type of money, tax qualified money. And so people don't understand that if I have to pay for $100,000 worth of care, that the IRS may take 20%, 30%, maybe even 40% in the future. So I'm only left holding the bag for 60 or 70 grand. And I still have $100,000 worth of care because the rest of it went to taxes.
That's right. And you're touching on a big area. I'll let you finish.
No, and so all I want to do is dispel the myth that if you have $1 million of 401k money or IRA money, tax qualified money, you have $1 million or $1.5 million, $2 million, recognize the fact that in a care claim situation, it's going to go very fast for two reasons. Number one, Uncle Sam, or better known as the IRS, is going to take a chunk of it, 30%, 40% maybe in the future, if income taxes go up. Number two is the nursing home or the nursing facility or the services is going to take the rest. And therefore, what is left for the wife? And let's call it back down to the female, right? What's left for her? Because those two institutions, the IRS and the nursing facilities, have taken a huge chunk of this tax qualified money. It was meant to do something else. It was meant to enjoy retirement, create income, etc. But now it's diverted over, and two different institutions are eating at it. And what is the wife left for? Let me get off my soapbox, Larry.
You hit a big area in two respects. I think of younger people, and I think of people that are retired. And I like the way you put it. You have retirees, and then what was the term you used? Experienced retirees.
Experienced retirees, yeah.
I like that.
New retirees and experienced. The experienced ones are 5 years or more into it, and they go, I wish I shoulda, coulda, woulda.
But you think about this, first of all, people just assume I'll just pay for this myself. And what they forget is you've got a liquid account, and your priorities could change.
That's right.
The guy could have a midlife crisis and said, I want to buy this boat that I've always wanted.
Yeah. RV. $200,000 RVs.
Yeah.
Like that.
Exactly. Or maybe their grandchild gets into a major college or university. So let's take some of that money we've been sitting on and help him or her out.
Yeah.
The bottom line is priorities can change with that money, and there's nothing stopping people from doing that. That's a problem. I know with my grandfather, it was interesting when he lived with us and he needed more companion type care, but light duty home care. Every time we liquidated his account, even though his cost of care was $10,000 a month, we had to liquidate close to 13 to 14 because of gains, because of taxes,
Wow.
fees to the advisor.
Wow.
You don't think about that.
Wow.
So whatever you think, when they say, what does it cost per month? It doesn't matter, because what will it cost you to get your money? That's the part people don't talk about.
Stop there. That's a good phrase. That's the phrase that pays. Is what is it? What was the phrase again? What does it cost you to get that money?
To get your money.
Yeah.
So then on the other hand, you talk about 401ks or qualified funds. That's when I think about people in their 50s who are stockpiling money away for their retirement. And I think, what a horrible thing, because they're still building the retirement.
That's right.
They're not there. They're not retired. They're not experienced retired. They are not there yet. They need that runway to build the retirement. And how awful would it be if you're like in a Christopher Reeve situation?
Yeah.
Paralyzed at the age of 42.
Yeah.
Guess what? You're going to destroy, as I like to say, deconstruct your retirement plan to make it a long-term care plan. So the funny part is, everybody, whether they know it or not, has chosen their long-term care plan. They just have a different strategy. Some
Right.
people say, I'll just pledge my estate.
That's right.
So that's real important. And they don't even think about, are there more efficient ways to fund
Correct.
long-term care?
Correct.
And that's where I think you're heading with that, because when you could use pennies to dollars as opposed to straight dollars, big difference.
So let's talk about that. That's a point. Let's start with one of the advantages of using some kind of long-term care insurance is leverage. Let's talk about leverage. You use the term pennies to dollars. So explain, what does that mean when someone has a long-term care policy? Why is it pennies to dollars?
When you think of the benefit that you've paid premium, it's saying, I paid $1 to get $4. That's the whole leverage of and not only that, there's tax efficiency to it. What you have created is what I call a long-term chronic or tax-free distribution. There's no more efficient way to fund long-term care than to a tax-qualified plan.
That's right.
So everything that, for instance, we saw with my grandfather or anybody who chooses to self-fund, you can't avoid the IRS.
Right. So you're highlighting two things, and I want to make sure we hone in and clarify that. First is the leveraging component that insurance does. So if you're paying, like this gentleman that I just was talking about on a joint plan with his wife, he's paying $5,000 of premium as a business owner, as a well-to-do business owner. He's been doing it for years. That's an annual for him and her, $5,000. And now the benefit is $1 million, over $1 million. That's leverage.
Yeah.
That's leverage. Okay. And it's $20,000 a month benefit for him and her both, or whatever. They don't sell those policies anymore. The other aspect is, and I explained this to him as well, is that $5,000 that he's paying is coming out of his corporation and is paid for that as a tax deduction. It doesn't get any better than that.
That's the best scenario. If you have a business, especially a C Corp, to run it through.
Yeah.
And to think about this also, universally, people underestimate what the real cost for their care will be.
Yeah.
I'll just set aside, I've done modeling, like you set aside 100,000 or 200,000. That'll do it. And then here's the deal. If you're going to be honest with yourself about this, first of all, you are underfunded already. But secondly, you're taking risks with that money. So if you're going to be honest about it, just lock it up in CDs or treasuries, which are the worst performing vehicles on the planet, because you need that money at any point in time, its current form, not after a market crash. What a terrible time. You think of 2008, what a horrible time if once 2008 hit, the real estate market crashed, and let's say you need care a month after that, you were in a terrible situation.
Yeah. Okay. So you're bringing the third thing up, Larry, is avoiding the market risk and this is what people don't understand, is what we call in the financial planning realm, the W effect, right? In other words, after I come out of that low valley, how long does it take for me to get back up if I don't do anything?
Right.
But if I draw money out of it for RMDs, required minimum distributions, if it's a tax qualified, or if I'm drawing money out all of a sudden for a long-term care thing, or if I'm drawing money out for that $200,000 RV, it takes a long time with high rates to get back to where you were.
Oh yeah. And if you're making those kind of expenditures, most people, unless you win the lottery or something.
Right. So it's important to see, to just to recap that, is the power of using leverage. And we've talked about health-based long-term care policies use leverage, but asset-based policies use leverage as well. Yep. In other words, for every dollar you put in, it is your dollar. It's always going to be your dollar. You may be getting $2.50. You could be getting $3 out of it. And then there, as you said, the number two thing was the tax benefits that come out of this using the 7702 or the IRS 101G. The tax benefits saying that when the benefits liquidate, they're going to be tax-free. Yep. It's important. And number three is to use a non-market correlated vehicle. It means that if the market goes down, the account does not go down.
In fact, it only grows.
It only grows.
If you have inflation in it.
Sure. Yeah. So it's beautiful to see that. Yeah. So that is great. And then I always talk about the tax-free bucket, Larry, and I always share with people on my whiteboard. People get on a whiteboard with me. I'm always sharing 3 buckets, left to right, tax qualified on the far left, non-qualified in the middle, and tax-free on the right. And I always put the tax-free in green. Let me say this, Larry, I've talked to a lot of people. Very few people have tax-free money.
No. Yeah, exactly. And this was interesting. When Washington did the Washington Cares.
Yes.
Suddenly I met neighbors I didn't know exist. They heard there's this insurance guy down the street. Better go talk to him. I hear he knows something about it. And so these are Boeing executives.
Yeah.
These are smart.
Amazon guys up there.
Yeah. They're coming by and introducing themselves and asking me about Washington Cares. And
yeah.
So come on in.
And your personal production went up?
Actually, it did. Yeah. But anyway, what was interesting, you sit them down and I said, do you really understand what long-term care insurance is? Because what the state of Washington is providing you is a 2-month benefit. Yeah. I said, most importantly, what kind of tax-free strategy do you currently have to pay your future expenditures for long-term care? And they look at me cross-eyed and I said, think about it. Typical policy will pay you $6,000 a month. IRS code 7702B says that money is tax-free. Not one penny of it's taxable. Yeah. You have no other way to do it. This holy smokes, I can't believe this.
Yeah.
And many of them did go and seek advice because they had no idea the tax treatment of it alone.
Yeah.
I think that in many cases is undersold.
Yeah.
I think agents get so assumptive about, they probably know this, or I say, you can't talk about that enough. There's no other tax-efficient vehicle, no better tax-efficient vehicle to fund long-term care than tax-free long-term care insurance.
The reason is, Larry, there's a lot of people with a gut feel. Gut fear is the word.
Yeah.
Gut fear that income taxes are going up.
Yeah.
Okay. We were at $35 trillion in debt. I don't know where we are today, and I don't know with all these cuts going on, I don't know where things are going. The point is, we got a lot of debt, and someone's got to pay it. And there's a fear that says that somehow, some way, if I have money in a tax-free bucket, it's growing tax-free and it distributes tax-free, then I'll be in a better position. And people don't have it. So getting back to long-term care, a traditional plan, I put it over there. Yeah. It is a long-term care plan. It is a tax-free bucket. It may be 100,000, maybe 150, maybe 200, maybe 500,000, maybe 800,000. Whatever that number is, it's tax-free, waiting to be spent for long-term care.
Yeah, and the more people can hear the term tax-free funding strategy for long-term care, then I think it'll resonate with more people.
Yeah.
They just don't.
Conversely, then self-funding from your tax qualified, which you just explained, with the IRS and is taking a large chunk out of it before it even gets to you.
Yeah, exactly.
So let's turn the page to another topic that we just alluded to. We are now years later from the Washington Cares Act. For those of us that are in Washington State, let's talk about this. And it's always fun to talk with an experienced person like you, Larry, because we have seen it from a particular situation where, for those of us in Washington State, we were forced upon a plan that I call a short-term care plan that is being operated by the state.
Yeah.
Whether it's there or not, I have no idea. I did have an attorney here in this area, very well-taught attorney, says, I remember him in a speech saying, this is a tax for the Medicaid system in the state, okay, on the backs of workers. Yep. But the point is, the state and every other state in the union and the federal government understands there's a problem coming down the pike, and they're trying to address the problem, okay? So what do you see with states? Are we seeing any updates here in the states, other states besides Washington State picking up a similar program where there is going to be some kind of state-funded type of care program with a tax associated? Do you see anything for 2025?
Nothing for 2025.
Okay.
In fact, the next state we thought would fall into that category was California, until they realized they had a $58 billion debt. And people I've talked to said, the state's acknowledging they couldn't even afford to promote the product.
Yeah.
But there's, I believe, 8 states looking at different versions. A couple of them are looking at a pretty heavy-handed approach of just a forced mandate. That won't go over well. But the challenge is Medicaid. And what'll be interesting, I'm hearing stories coming out of Washington, D.C., where with all the change going on and so much responsibility being put back in the state's hands, there will be block grants if that happens for Medicaid that would otherwise have come from the federal side anyhow.
Okay.
I think however people look at it, they need to do real and honest planning right now, because you can't assume what's going to happen. And I'm hearing with Washington State, there's a plan in place to launch, though we don't know all the details, but the thought is they're launching a supplemental rider to the existing plan, because $36,500 is just a joke. But what will that get you? We don't know. Is it like one more year? I don't know. But that's the discussion here.
And we're both residents of Washington State. And the sad thing is, and this is just cuts to the quick on things, is while the state is operating a short-term care plan, they won't allow any short-term care plans from insurance companies in the state, which to me, if I was in a law firm, I would look at that in a heavy way. So anyway.
And I'll just have to throw this out there. If a private insurance company tried to file and get approval for a plan just like the Washington State, they said, no way.
Yeah.
That's not going to meet the needs of the consumer.
Yeah.
And meanwhile, forced mandate on something that doesn't meet the needs of the consumer.
Exactly. So for myself, I'm selling short-term care plans in other states.
Yeah.
And it is really, and just to touch on short-term care for a moment, It is really meeting the needs of what I would call middle income retirees, right? Those are just getting by, right? But they do have the ability to have a nice pool of money of maybe 30,000 or 50,000 or 90,000 or maybe even 100,000 that pays for only for 1 year. Maybe it's paying for 3 months. It could be 6 months, could be 9 months, 12 months. I have really looked at it, Larry, and I can say that your premiums for something in there is going to be somewhere in the neighborhood of 75 to 150 a month. You can get something decent in there.
Yep.
And getting back to care problems again, when we live out in the country here, when there's a fire that's starting to happen in a house,
Yep.
the fire department is going to be 15 minutes away, maybe 20 minutes away. All right. 30 minutes away. And so I do have a garden hose that's plumbed in the house, Larry. I do. All right. There is a garden hose that's meant for the very thing that if there's a fire, we have a garden hose in here to start taking care of. That's what I think of the short-term care plan is, right? It's there that the fire started. I don't know how long the care situation is going to go on, but at least let's take care of it from day zero.
And I think short-term care is becoming a very successful product out there also because it's addressing the reality of the health of America post-COVID. So they're easier to qualify for. And a lot of people who have health issues are going into short-term care plans because they can't get anything else.
And they're gender neutral for pricing. So going back to gender-based pricing or gender neutral, so males and females are priced the same on short-term care. So just the word, if there's folks that are listening or watching from another state, these are currently not, short-term care plans are not offered in Washington State, New York, California, and a couple other states that it's worth looking into and make it affordable. And so it's a beautiful thing. Let's talk, switching gears a little bit. Let's go back to the difference. We kind of alluded to traditional versus asset-based long-term care. You and I are both proponents of both kinds, both the traditional health-based and asset-based. But as we know, there is going to be sweet spots or considerations. So let's talk about our favorite business owners or executives, okay? Talk about the pros and cons with regards to either an asset-based or a health-based.
Sure.
Long-term care.
We see typically traditional products in the executive carve-out realm in the worksite area, primarily because of pricing and the tax treatment of it, depending on how deep the pockets are.
Yeah.
An executive team may want something with guarantees in it.
That's right.
Either way, there's a fit because once businesses realize, holy smokes, let's keep the math simple. Let's say you've got 10 executives and we'll buy a $100,000 plan for each of those executives. And maybe the premium's going to be 20 grand a year to the company. That 20 grand represents $1 million worth of tax-free benefits.
Huge.
And another area when the economy is soft and it's not really the right time to increase payroll expenditures with bonuses or pay raises, this is an incredibly efficient tool to provide a ton of value to their key employees and not cost the company much or anything at all, depending on their corporate form. The one area that I see an interesting division in the worksite arena, it's more about indemnity versus reimbursement. And I'll tell you why. This was an interesting experience I had many years ago when I was at Marsh McLennan. There was a company called MedAmerica. Remember them? They were a cash product. Cash is king. And I presented Hancock, MedAmerica, and it wasn't MetLife. I can't remember what the other one was. And of course, it was an executive team in Portland, 12 execs. They all thought, I like the idea of getting a check. That seems so easy and simple. And of course, I'm the agent and I'm saying, yes, whatever appeals to you, I have it, right? Anyway, long story short, we get to the finalist meeting and we're just reviewing everything we walked through. And the CEO said, now hang on a minute, I got a question for you. So, okay. He says, listen, don't get me wrong. I like the idea of getting a tax-free check in my mailbox, but let's be frank, I'm not going to be able to handle that. And if I'm in my 80s, can my wife handle that? I said, okay, I understand. So I said, do you have an executor or a trustee? I do. And that's what I'm worried about. I said, really? Tell me more. He says, listen, it's my daughter and I love her to death. Her husband, rotten. Those are the words he used, rotten. Let me ask you this. He said, if my daughter is receiving the money and her husband is aware that the money's coming, what would prevent him from going to her and saying, listen, we need some new tires and shocks for the Suburban. Maybe we can just borrow $3,000 or $4,000 of that money and pay your dad back later. Could that happen? I said, absolutely could. So what can I do to assure that 100% of my benefit dollar is going to its intended purpose? I said, now you're back to reimbursement plans. So that's, I think, where the more interesting divisor is. But it's all going to come down to cost. Or if there's a real penchant for guarantees and the ability to recapture the expense, then that's where hybrids fit in pretty well.
So let's go back just to make sure people understand the difference when we're talking about indemnity versus reimbursement. And the reimbursement states that there has to be some kind of care facility submitting bills monthly for the services.
Or care provider.
Care providers. Care providers in the home, care providers at the facility. They're providing the invoices and the insurance company is being reimbursing on that amount.
Exactly.
Versus indemnity. So if the indemnity plan, there are some rich indemnity plans out there that can be $10,000. That's a cash play. That was your question. You're bringing up an interesting point, Larry, about about whoever the managing caretaker is now. Because remember, now daughter is no longer a hands-on caretaker. She's a managing caretaker, but her husband is a, what would you call him again? A rotten. He's just rotten. So all of a sudden he sees 10 grand coming in.
Yeah. Yep.
And that 10 grand. And here's the other thing too, that cash policies would do, or indemnity, was that, correct me if I'm wrong in this, it's going to drain the policy quicker too, because it's maxed out, tapped out, and you're just going for it.
Exactly.
Whereas a reimbursement, if someone's got a $10,000 reimbursement play and the bill is $6,000, there's still $4,000 left in the policy.
And it's still growing. So you bring up some very good arguments for the reimbursement model. Now, help me with this. I'm going to flip it on you on reimbursement. When you get down to the rural areas, and I'm here, you're here in my home studio office. We're out in a rural area. Reimbursement, or even more rural than this, reimbursement can start to be a problem though in the rural areas, or no? I mean, in terms of agencies getting out there, et cetera. It can be. There's for instance, pretty much all the reimbursement carriers require billing, and they require licensed caregivers, not informal caregivers. And you probably have scores of informal care providers here. So where's the rub? I know with our company, if that becomes an issue, then it's a matter of, okay, who would it be? As long as it's not a family member, if it's somebody who has a business and this is what they do, they'll consider that. But at the end of the day, to bypass that whole risk, that's where indemnity is not a bad play, because you do have that control.
Let's go back to real quickly addressing the business owner again from an asset-based versus a health-based, and let's lay them out side by side. So as we know, the long-term care premiums are tax deductible under the IRS code 7702B particularly for a C Corp, and then they have to check with their CPA for other entities. But with a health-based premium, that's completely write-offable under those situations. Again, check with your CPA. With an asset-based, there might be a life insurance component there, and the life insurance piece of it is not. But there's a long-term care premium that's broken out as well, and that is. And so we're talking to executives and business owners that are high-end or that want to really help their people. You could see on the asset base, you could do a golden handcuffs where there is a benefit on the asset. So the life insurance is being taken care of by the company. And it's knowing the fact that that executive or business owner rolls into retirement and they do have that asset-based long-term care. So there is some nice benefits there. But again, the tax benefits are going to be different, and the long-term care benefits probably are going to be different as well.
Yeah.
Less leverage on the asset, but it's an asset.
That's correct.
So it's good to see that. Let's go to young professionals.
Okay.
Let's go to young professionals in their 40s, maybe early to mid 50s. All right. I think you would agree that probably the health-based traditional long-term care is a strong play to look at this point.
Yeah, because there's a sheer amount of coverage you can buy.
Yeah.
Also, there is a question that comes up though. Could this person use more life insurance?
Yes.
And that's something you also want to weigh for a younger person as well. Typically, when we talk to people in their 50s, they're pretty well taken care of at the life insurance level. So there's less of a need for that, unless they have an overriding concern that I want my money back if I don't use it. I get it.
Yeah.
But I think that at the end of the day, it's going to be how much coverage can I get? And especially if you emphasize the tax-free aspect of it, how much tax-free benefit can I get for the dollar? And traditional is going to always play a little stronger in that regard.
Yeah. And let's talk about those employees, those executives and such like that are in their 50s and they take a traditional HSAs.
Yes.
They can be paid. They can pay those premiums.
They can.
Isn't that a beautiful thing?
And if it's a C Corp, you're not restricted to the tax table. It's the full thing, which is pretty powerful. I'll tell you something that is interesting, though. I ran into this in another situation a couple years ago. It was a Lexus dealership group down in the Bay Area, San Francisco Bay Area. They own 5 different dealerships. And the average age, the ages span from as young as 54 to as old as 68 years old.
Wow.
And the conundrum they were having is that because of our older execs, the cost of their DI was becoming onerous to the company. So I was invited in to talk to them about this and talked about tax treatment of long-term care and how it all works. And because DI, that's income.
Yeah.
DI benefits are income. And it gets progressively more expensive. So I said, maybe you think of it this way. This is the DI for the rest of your life.
That's right.
I said, really?
Yep.
So now I'm not encouraging you to drop your DI.
No.
But I'm telling you, this DI is going to end at some point.
That's right.
Usually age 70. And then after that, you're on your own.
That's right.
I'll make a long story short. They made the business decision to drop the DI because they had a disproportionate number of older people. I didn't encourage it, but they were more concerned about the CEO and the other guys because they were getting really expensive.
Gotcha. Yeah.
But anyway, I don't know if we're going to go more into the business space and kinds of businesses and kinds of people that found long-term care insurance planning appealing.
I want to stop because you mentioned that group. I'm going to go back to that group.
Yeah, okay.
There's an interesting play because I dealt with a group of 5 doctors in Oregon one time, and they had taken out DI. These 5 doctors taken out DI through somebody else. And I remember sitting at their boardroom table.
Yes.
And I said, do not have the corporation pay for those DI premiums. And guess what they were doing?
They were paying for
They're paying it. Out of the 5, 2 are extremely healthy. And we're talking late 40s, extremely healthy. 2 of them were really healthy. One of the 2 became sick with a very aggressive cancer 3 or 4, 5 years later.
Oh my.
Okay. Guess what? The corporation was paying for the DI coverage. And so instead of the $20,000 of income that he was being owed by the insurance companies, he was getting out about 12.
Wow.
Because it becomes fully taxable when the corporation has been paying for it.
It's income. Yeah.
But to your point, long-term care, had that been set up, it's fully tax write-offable. I love that word.
Yeah, write-offable. I like that.
So it's an interesting play that, yes, the long-term care component, tool, strategy will last longer for that person's life because it's going to be with you forever unless you come down with something. Whereas a DI policy, I'm very much an advocate of it, and I can say how they play together.
Yeah.
But like you said, DI policies will come off the books at 60, 65. If they're running it all the way to 68, 70, that's a really expensive endeavor.
Yeah.
But yeah.
And I think you said something important. There is a natural marriage with those two.
There is.
Because the question is, okay, I need to replace a portion of my income if I can't work, but then there's a caregiving expense that would follow.
Yes, right.
And that's the kind of where they come hand in hand.
That's right. And if anybody looks me up on an appointment, I will whiteboard it for them. I know exactly how there are two bell curves. One's inverse and one's up and one's down. When it comes to DI is an income replacement. And long-term care is an expense replacement.
That's a good way to put it.
And so you got to get both of them to handle that. And before we're leaving the executive play I'm on the DI side because I write DI as well. And that is, it may maybe worth it as the expenses go up or whatever. Maybe they shorten their DI policies a little bit to manage that aspect. To say, hey, at least get 2 years of income out of this. Anyway, it's a sidebar on the DI side, but to do something like that. The young professionals, we talked about those. Let's talk about new retirees, Larry. Let's talk about the 62 to 67-year-olds. These are the folks, I'm talking turning 65. We're doing the broadcast on talking turning 65. What do people do as they enter this 62 to 67-year-old range when it comes to two forced decisions they're having to do? One is Social Security and the other is Medicare. They're being forced at 65 on the Medicare decision. But there are two other decisions. I'm not going to go into the other one, but one of them is long-term care planning. They're not forced, but they will have regrets in their 70s if they don't make a decision.
Yeah, and frankly, what we see as far as people qualifying for coverage through underwriting, once you get up into that 67, 68 range and older, fewer and fewer people are qualifying because they've had health issues or have health issues that are actively playing. It's that age group that's most alert and aware that, okay, I think I'm ready to make the decision. That's probably, they've made that decision at the most expensive time they possibly could, both from the health standpoint and also the financial standpoint. But that's a group that's eager to have the conversation. The younger folks, and I'll talk about the younger group for a minute. What I have found to make it sound more compelling to somebody in their 50s, I ask the question, let me ask you, when you think of long-term care, what images come to mind? And I get Grim Reaper, I get nursing homes, sick old people, and I may not need to think about this for another 30 years. I get all that. And I said, okay. And if you think about that, think about this. Is it possible that you can get in a serious car accident or you're working on your roof and you fall, you seriously injure yourself? Do you think that's a possibility? And they said, yeah, I guess it could be. He said, listen, this isn't about old sick. This is about when you become disabled for a long time. You may recover, you may not. When you look at how the insurance works, let me show you how you access benefits. Does it say anywhere that you have to be 84 years old before you can trigger benefits or that you have to have a stroke or something? No, you just have to meet the eligibility trigger. So it's really, from a health base, I emphasize disability from that standpoint. And suddenly it resonates because they identify disability as something, I'll get better. And they're leaning in more with that conversation.
That's very good for the young professionals. And as we said before, Larry, we don't have to buy a huge policy. We can stack if we want to stack, but at least get something in place, right?
Exactly.
And if it's $150,000 per Mr. and $150,000 for Mrs., look at that and just say, hey, that's something to get us going. It's going to be compounding along the way. And we're going to talk about your company a little bit, hear about all the good things they've got going on with price stability and all that. So let's wrap up with, and going back to the new retirees, 62 to 67, that's where I'm really looking at the asset-based, right? So I'm really looking at saying, hey, we're now at a stage here where you do have an issue and you're willing to transfer an asset, as we know, from your left pocket to your right pocket. And can you do that so that you're protecting all your assets and giving your family freedom during that time and yet still have an asset? At the end of the day, it's still yours.
Yeah.
Now, I will tell you something interesting, Larry, going back to traditional, I just did this with somebody where they picked up a short-term care plan, a single gal, a nurse, picked up a short-term care plan. She peeled off, and she's not like wealthy, rich or anything like that, but she peeled off a portion, a little bit of money from her IRA to put it into an annuity SPIA. We put it into a SPIA. Yeah. So that SPIA says that it's going to pay annual payments for the rest of her life regardless. And therefore, she's going to use that to pay the premiums every year.
Right.
And so the same thing can be done with your traditional long-term care. You might be still there, but at the same time, you just have to look at all the scenarios to say, hey, I'm not necessarily willing to go get an asset-based at this time for whatever reason, but is there a little bit of that tax-qualified account that you have that you can peel off and let that make annual payments, which you make to the insurance company for the bucket that you now have.
Yep. And I love HSAs. I have them
Yes.
myself. So
Yes.
I'm a big believer in that.
And VIBAs.
Yep.
For those who work in the governments, the VIBAs are there too to pay for that as well.
Yep.
All right. So I'm turning the chapter here. Do you have any recent LTC claim story? Anything?
Actually, we don't, because we're so young in the business. I'll fully disclose. We have 4 active claims.
Okay.
Since 2016.
Holy moly. Only 4 active claims with your company.
Yeah. Yeah.
Wow.
So, we don't have any real exposure yet. And we think it could be another 10 years before they start really coming in.
I got one for you.
All right.
I got 2 for you. I'm going to share 2 stories.
Okay.
One is our neighbor up the way. Her husband, we moved here 18 years ago, and her husband was in his early 50s, and he got cancer and died of the same lung cancer my dad had. It's a sad story. As he was sucking on oxygen and the cancer was whittling, he told me in his foyer there, he says, Mark, he says, take care of my wife with whatever you do with that long-term care stuff. And I waited some years. And then I finally approached her. I said, Mary, I said, you need to get this as a good plan. So we got a plan. She up and went and got a pancreatic cancer. Boy, I tell you what, Larry, we got to see claims like that elimination period thing. That's a long time. Now with that carrier is 20 days. Holy moly. Yeah. We need care. But I'm telling you, from a claims perspective with her, it was, again, how do we get care out here now? My wife goes up and takes care of, she's doing the night shift. If you're getting her up to the bathroom and all that, my wife gets sick after 3 nights of this.
Wow.
Okay. Yep. And so I can't tell you how fast you need care in here to help the family members, Larry. That's what I'm getting at. And so we finally got it turned on. She didn't last that long, but the aha moment was we need care and we need it now. So if folks have elimination periods of 90 to 180 days and you're in a state that has a short-term care option, man, I'd look at putting a short-term care up in front on that thing. Just a thought.
That's personally how I set up mine. I have an old policy from Prudential, but I won't disclose companies, but I have, it's basically a short-term care indemnity product with a 0-day wait. And it'll get me through a year. And then I couple that with a longer elimination period on my traditional product. So when one is done, the other one's kicking in.
Beautiful. No, that's good. That's good. The other case just happened. He's an insurance agent here in the Eastern Washington, Eastern Oregon area, 72, very healthy. And his wife came down with a autoimmune system thing within 12 months. But I was on the phone with him here just the other day, and he was mentioned to me, he says, Mark, he says, and he has CNA. Remember that company?
Oh, yeah, I remember CNA. Yep.
Guess what? They paid, and they were paying big. You got to get him going, though. Yep. But he had $10,000 or $15,000 worth of benefit available. It was an old CNA policy. But the beautiful thing is, he was telling me, he says, Mark, he says, I wanted to have the best thing. Family was around, their care at home, and they were going for 8 hours a day, and they had enough benefit there he says, if we need to go 24 hours, we could get there with the policy. But the point of it is he couldn't, even though it didn't last long, it was the ability to say, and he's talking to his kids, he says, hey, if we need to go to Bend, Oregon for even better care than what we have out here, we're willing to do that. So I guess it offers a lot of options and availability for those that have that lifestyle, that want those freedoms, used to that lifestyle. It offers freedom to do that.
Yeah. I can tell you stories in absence of insurance of how bad it was. I just look at my own family.
Yeah.
My great-grandmother, she was in a nursing home for 8 years.
Yeah.
My dad's mother. And I remember when I got into business back in 90, she kept thinking I was wholesaling Medicare supplement. I said, no, this is long-term care. So we already have it. I said, no, you don't. And I just couldn't convince him of that. But the last person in the planet you'd think would get a stroke. She was very active in the community and all this stuff. Massive stroke, paralyzed on one side. And she was in that state for almost 7 years and depleted her estate. She was in a nice boarded care home, wound up moving in with my dad the last 3 years of her life, and they took care of her. But that's when you integrate long-term care planning, proper long-term care planning, you're also integrating certainty and predictability that you simply won't have.
Yeah. Yeah, that's good. Another topic, turn the chapter, walk me through, and I did this years ago, but walk us through what's the process for that executive class that are looking to do a carve-out. Let's go through some of those steps about that. Generally, what I found too, is there's some executives or owners of the company that said, you know what, I dealt with mom or dad. I don't want to go through it. How does my company pay for this? And the people, the gals in the C-suite can do something. And one of the things is it's discriminatory.
Absolutely. That's what underwriting is all about.
But it's also from a tax perspective and a company. Yeah. So just be clear about what discriminatory means. That means that in the company documents, it can be written that based on title, what's it? Tenure,
yep.
Title or tenure,
yep.
That
also employee class,
right? That certain these ones based on those configurations can be paid for 100%.
Absolutely. In fact, long-term care it's a very unusual benefit in the sense that you can discriminate. You can offer it to certain employees or offer different plans.
Right. So you can go to the rank and file and offer possibly a situation where there's a base level. And if they want to buy up from there, they can do it, or it could be completely voluntary.
Yep.
It could be whatever. But the point is, for the executive carve out, that's what it means, executive carve out, discriminatory. And I remember talking with an older benefits guy here locally. He just couldn't, he's very seasoned, very experienced, very knowledgeable. He just couldn't believe how cool this was.
Yeah. Employee benefit brokers are, when they learn about long-term care, suddenly it's, wow. This is, when you think about a business and bringing in long-term care as a benefit, I ascribe to the 3 R's.
Okay.
What are the 3 R's for a business? Recruit, reward, retain.
Yep.
So symbolically, this benefit to the employees, if they haven't had experience, is the company basically saying, we care about your future beyond your years with us here.
Yeah.
That's why we think that this is an important benefit.
Got it.
And for the younger employees, it's 401k insurance.
Yes.
For those that are nearing retirement, when you're off to retirement, then you're protected there. So there's a symbolic importance that anybody who's engaged in that space, don't lose sight of what the business is trying to do. Because if you're in a competitive marketplace, salaries are about the same. Where do you draw the line and show you have one leg up on someone else? It's benefits. So if you have a stellar long-term care program in place, not a lot of companies do yet. Big ones do, but there's so much room in the small business environment for them.
That's a big deal.
Yep.
Okay. So let's turn the page and let's talk about your company.
Sure.
NGL.
National Guardian.
National Guardian Life. How long has it been around?
The company itself, since it's about 110 years old. It's a mutual company out of Minnesota. I will tell you, when they approached me 4 years ago, I'll be honest, I said, NG who?
Yeah, exactly.
And I was frankly a bit of a skeptic. And my current boss, great guy, says, I'll tell you what, I'll let you talk to the CEO. And I thought that was going to be a 10-minute raw. It was a 2.5-hour conversation.
Wow.
About risk, numbers, the whole bit. So when you look at us, now pretty much the marketplace knows who we are. We don't have the name recognition of a nationwide or whatever. But anyway, long story short, I think what sets our company aside is that fortunately we were very late to the dance in the LTC realm. We didn't enter the market until 2016. Interest rate environment was still horrible for insurance companies. So we priced for that. Our lapse assumption is virtually nothing. So we didn't miss that mark, and we underwrote properly. As a consequence, we're right now in the very early stages. As I mentioned, only 4 claims so far. Very healthy, profitable book, and no legacy business to jump on us in the back end at all. So the luxuries we have that none of my competitors really have is financial flexibility. So future products, one we're going to be filing soon, significant improvement to what we have, but we can afford to take less profitability and still make it a responsibly priced product. So I think that, to me, is the most important thing. The other thing, when you think about where we fit in the market, we are best when it comes to couples. We built a product for couples, really. And when you look at the pricing of it, it's interesting because 2/3 of your joint premium is because of the female. The males are less. So I say there's our financial position, there's our product position. We have a worksite program that's about to get significantly better. But I compete on the financial story more than anything else.
And I think you guys also compete on the ability to short pay premiums as well. In other words, do you have different, say,
10 pay?
A 10 pay.
Yeah, we got a 10 pay.
Do you have a paid to 65?
Don't have.
No, just a 10 pay.
Just a 10.
Just a 10 pay. Okay. So let's talk about what a 10 pay means.
The way we approach 10 pay, you make 10 premium payments and it's paid up.
Yep.
We can never come back to you for any more money, but
right.
Because of our position, we took the 10 pay a step closer or further, I should say, and guaranteed it.
Okay.
What's also interesting with our 10 pay is that if you were to have a long-term care event midway through, let's just say you're paying on that policy a couple of years, say 2 years, and then you have a 5-year period where you need care and then you recover, do you have to pay all those 5 years of premiums and then some? No, you just pay what's left. You've hit the lottery.
Wow. So waiver of premium in that if you have a 10 pay going on and you get sick, or then you're not having to owe the back premiums, it's just a waiver of premium.
That's correct. And the waiver of premium is only a one-time deal. If you do it once, you'll never do it again.
That's right. That's right. And then you're announcing, or you're putting out there too, that the employer market's going to be more and more appealing. The group platform is becoming more appealing as we go along here too.
Yes.
And I really think that is as well. And you're going to be held like the rank and file employees be able to get something if they want to have something.
Yeah. So what we have is simply a unisex premium. No underwriting concessions.
Okay.
So that's it. And the unisex premium is interesting because it benefits couples and it benefits women. Guys get penalized. So if you have an all-male group, don't even go with the unisex premium.
Yeah.
But what we have coming down the pipe, because we still see the small to mid-sized business market is underserved by our industry. So we're going to offer underwriting concessions. We'll have a guaranteed issue option. We'll have a simplified issue option, which is a fancy way of saying a much shorter application. And we just pull Milam and Met data and not formally underwrite the case. We just go off medical records. And then we do have for small groups, 5 lives or less. That's an underwritten option. Anyway, it'll be out towards the end of third quarter.
So. Wow. That's exciting stuff to to have a carrier that's a mutual company and came late to the dance. And so you were able to work off of everybody else's mistakes.
We benefited from the great learning curve we talked about in the very beginning. You know?
Hired guys like you away from the other carriers that went through all that and have the knowledge.
Yep.
And then get creative with take it to version 2.0 or even 3.0 that we're going into a situation where the employer market getting more availability in the employer market, the work site, because it's really needed. That's a great thing. Very good. Anything else about NGL to share before we jump off that?
Just aside from, we do have a new product filing that's going on now in the compact stage. That's a significant improvement, but we've actually gone pretty high tech in a number of areas.
Okay.
Electronic policy delivery. So that's paperless. We have a client portal that we have in place now, so clients can go in and look at their policies and benefits.
Okay.
They'll soon be able to pay their premium on it too.
Okay.
That's version 2 and all that. But yeah, we seem to be one of the only carriers doing things.
Right.
And a lot of it's technology.
So then we'll go back to the claims process for just a moment. I know you only have a very small amount of claims. You've been in the NGL got into the LTC business when?
2016.
2016. So coming up on 10 years. The company's been around for over 100 years, but in the last 10 years, what is NGL's position on claims? Do they turn it over to a third party when it comes to a claims, or they handle that in-house, or how's that working? Is there a process to share? What is that?
That's a great question, because that was my concern when I was first talking. I said, you guys don't know what you're doing. We work with a third-party administrator who's been in the business for over, 30, 35 years. At their peak, they were probably handling 20 or 30 major carriers on the admin side, underwriting, new business, claims. So this TPA of ours is a very seasoned claims payer. They're paying hundreds of millions of dollars of claims already. So when NGL made the decision to go into this, they said, let's not try to reinvent the wheel. Let's find somebody that knows that side of the business inside and out, and then we'll share the risk with them. And that's how it's worked. So we're on the paper side, and we build the product, design the product, and we jointly price it. We let our TPA we work with do all the administration, and it's worked out very well.
That's good, to have that, because I'm getting more and more cognizant of the claims area, Larry, because it's near and dear to my heart. As we move forward, more and more people are going to have these claims. As an agency, I try to strive to be there for them, and looking for carriers that are going to be there to smooth that process out. Yep. Very good. Thanks for jumping in the studio today. We went over a lot of topics here, and I think we're going to go ahead and go live stream here in a minute or two.
Great.
Thanks for jumping on.
Thanks for having me.